There is a moment in every major crisis when the same thing happens. Prices start climbing, currencies start wobbling, the news gets loud, and millions of people watching their savings lose ground in real time make a sudden decision to buy gold. They feel smart doing it. They feel like they figured something out. And in the short term, they often feel vindicated because gold almost always rises in the early panic. But here is what history actually shows, over and over again, across centuries and continents and crises of every shape imaginable. The people who buy gold in the middle of a crisis are almost never the ones who benefit most from it. The ones who benefit are the ones who bought it before anyone was paying attention. This is not a coincidence. It is a pattern so consistent that it almost functions like a law. Go back to the 1970s in the United States. Nixon had just severed the dollar's last connection to gold in 1971. And for most Americans, life felt fine at first. Inflation was a background noise, not a siren. Gold was trading around $35 an ounce when the link was cut. A few people started buying quietly. Nobody was writing newspaper headlines about it. Nobody was calling it a crisis hedge. And then the oil embargo hit in 1973. Inflation started accelerating, and suddenly everyone was paying attention. By the time the average American household felt the urgency to buy gold, the price had already doubled. By the time the crisis reached its emotional peak in 1979 and 1980, gold had surged past $800 an ounce. The people who bought in 1971 or 1972, when there was no panic, no urgency, no obvious reason, had multiplied their money more than 20 times. The people who bought in late 1979, swept up in the frenzy, bought at the top of one of the most dramatic gold runs in modern history, and then watched it fall for the next 20 years. That is the pattern. Not a theory, a pattern. Go back further. To Weimar Germany in the early 1920s. The hyperinflation that consumed the German mark is one of the most documented economic catastrophes in recorded history. By November 1923, a loaf of bread cost billions of marks. Wheelbarrows of currency were being used to buy groceries. And yet, the Germans who had quietly converted their savings into gold or hard foreign currency in 1920 or 1921, before the collapse became obvious, were not just surviving. They were, in relative terms, becoming wealthy. They could buy property, businesses, and assets from desperate sellers at fractions of their real value. The people who waited until the newspapers were screaming about inflation, until the crisis was undeniable and visceral, had already lost most of their purchasing power. By the time they thought to buy gold, they could barely afford it. The mistake is not buying gold. The mistake is timing it to the crisis itself. This matters because of something deeply human in how we process risk. We are wired to respond to visible, immediate threats. When the economy feels stable, buying gold feels paranoid, even embarrassing. When everything is collapsing, buying gold feels rational, even brave. But the market does not reward feelings. It rewards positioning. And gold, specifically, has a history of being priced by the time the crowd arrives. Look at what happened in 2008. When Lehman Brothers collapsed in September of that year, gold actually dropped sharply in the immediate aftermath. Investors were selling everything to raise cash. Gold fell from around $900 an ounce to below $700 in a matter of weeks. The people who had bought gold in 2005 or 2006, when the housing market was still being celebrated as a miracle of modern finance, watched the initial crash with calm. They held. And then, as the Federal Reserve began its historic money-printing response, as the bailouts piled up and the balance sheet of the central bank exploded, gold began a climb that would take it from that $700 low all the way past $1,900 by 2011. The crisis did not create the opportunity. The crisis revealed why the positioning mattered. But the positioning had to happen first. There is a second mistake embedded inside the first one, and it is subtler. When people buy gold in a crisis, they almost always buy it for the wrong reason. They buy it because they are scared. They buy it as an emotional release valve, a way to feel like they are doing something. And when you buy anything out of fear, you almost always sell it out of fear too. The moment gold dips during a volatile period, the same panic that drove the purchase drives the exit. This is how ordinary investors consistently manage to buy high and sell low, even in an asset that, over long stretches of history, has preserved purchasing power remarkably well. The historical record on this is almost painful to read. These studies of retail gold buying behavior show that inflows into gold funds and coins spike dramatically during the most visible moments of financial stress, exactly the moments when professional and long-term holders are either already positioned or are carefully watching for the panic to peak before they consider selling. The crowd and the sophisticated money are almost always moving in opposite directions. This is not because sophisticated investors are smarter in some abstract sense. It is because they have internalized a different relationship with time. Gold is not a trade. It is not a reaction. It is a long-duration store of value that works across decades, not news cycles. When you treat it like a trade, you expose yourself to all the volatility and none of the preservation. When you treat it like a foundation, you stop caring about the noise. Consider the experience of central banks themselves. After decades of selling gold reserves in the 1990s, a period when gold was deeply unfashionable and prices were depressed, central banks around the world began quietly accumulating gold again in the 2000s. Not because a crisis was happening, because they were thinking in decades. By the time the 2008 crisis hit, by the time the 2020 pandemic shattered supply chains and triggered the largest peacetime money creation in history, those central banks were sitting on reserves that had appreciated enormously. They did not buy gold because they were scared. They bought it because they understood that the conditions that make gold valuable, currency debasement, institutional instability, long-run inflation pressure, are not emergencies. They are slow-moving structural realities that reward patience and punish reaction. There is something almost counterintuitive in this that history keeps confirming. Gold is most valuable precisely when the conditions that make it valuable are not yet obvious. The moment those conditions become obvious, the moment everyone can see the inflation, feel the currency erosion, read the headlines about financial collapse, the price of gold already reflects much of that reality. You are not getting ahead of the problem. You are paying for someone else's foresight. This played out again in the years following the 2020 pandemic. As governments around the world injected trillions into their economies and central banks held rates near zero, a small number of investors began quietly increasing their gold allocations in 2020 and early 2021. By 2022, when inflation became impossible to ignore, when the Federal Reserve began its most aggressive rate-hiking cycle in 40 years, when the headlines about purchasing power destruction were everywhere, gold had already made a significant move. And then it entered a grinding, frustrating sideways period that shook out the reactive buyers, the ones who had rushed in because the crisis felt urgent, before eventually resuming its longer-term trajectory. The people who got shaken out were not stupid. They were just operating on the wrong timeline, responding to a crisis signal when they should have been responding to a structural one. There is one more layer to this that almost nobody talks about. When people make the crisis timing mistake with gold, they often do it in the most expensive possible form. They buy gold jewelry at retail markup. They buy gold coins from dealers charging significant premiums above spot price. They buy gold ETFs without understanding the fee structure or the counterparty risk. They buy mining stocks, which behave more like equities than like gold itself, and then wonder why their gold holding fell when the market fell. The urgency of the crisis moment collapses the careful thinking that should go into how you hold gold. not just whether you hold it. The historical survivors, the people who actually preserved wealth across the German hyperinflation, across the collapse of the Soviet ruble, across the Argentine peso crises, across the long inflation of the 1970s, were almost uniformly people who held physical gold in a simple, direct form, acquired before the crisis and held through the crisis without flinching. They did not optimize the entry. They did not time the exit. They treated it as a permanent layer of their financial architecture, not a tactical move. That distinction, permanent layer versus tactical move, is perhaps the most important thing history has to say about gold and crisis. Every generation rediscovers gold when the crisis arrives. Every generation pays the elevated price. Every generation experiences the volatility of holding something they bought out of fear. And every generation produces a small number of people who had already been holding it quietly, who bought it when nobody was interested, who are now watching the crisis unfold from a position of genuine stability. The crisis does not create the gold opportunity. The crisis reveals who already had the right idea. And the right idea, the one that history rewards with almost mechanical consistency, but is never the one that feels urgent. It is the one that feels boring, premature, and slightly unnecessary, right up until the moment it is not.